Good afternoon, everybody. So today's 4th September 2019, and as I mentioned, today's webinar is going to be a very good one. If you have a strategy, or if you're that person who trades every day, then this is the correct webinar for you. So before I start, we are basically just going to look at how to prepare for day trading. We'll start first of all by looking at the types of trading first of all, and then we'll also look at some of the strategies that you can apply as a day trader. So the first thing, the word day trading actually does not mean scalping. The word day trading is not another word for scalping. Day trading means that anytime you enter trade, it actually takes some days. But if your trades are always within some minutes, seconds, then that's what we refer to as scalping. So what I'm going to talk about basically is how to trade, how to be able to hold trades for some days, and not how to hold trades for some seconds. The main reason I'm saying this is because I don't personally advocate for scalping. Scalping is really good, a very good strategy. It can give you a lot of money, but you look at the risk aspect of it and the fact that the spreads can fluctuate on your side, against you or on your side. So the first thing here is that what I'm going to look at is that day trading is not scalping. It's trading, holding trades that will last for a whole day, several trades, but must not go above 1 week. If it goes above 1 week, then that's position trading. So the first thing I want to mention is that any strategy I'm going to teach in this webinar, any strategy which you'll hear me talk about, all of them, they're just 50% successful. So the other 50% depends on how much risk, how much you calculate your risk percentage. So the fact that I'm going to talk about a strategy as if it's the best, but it's actually not the best. The most important strategy, any trading strategy that you're having, is actually the risk strategy. Anytime you enter in, whether you know anything or you don't know anything, the strategy which you already have is the risk, the amount of risk you are willing to lose in a trade. That's the strategy. So whatever you choose to trade, whether you're doing whatever you're doing, whether you're doing scalping, position trading, you're trading engulfing, spin bar, or whichever, all of them are only 50% successful. Because anytime, if I'm saying that this is a pin bar, this one, yeah, I'm saying that this is a pin bar for a sell, when entering here, it's actually just 50% chance that it may go down or it may come back to the upper side. It's not a guarantee. The fact that you have a pin bar here does not mean that the price is supposed to continue to the lower side. Sometimes you can have a pin bar, have every indication that the price is going to continue down, yet it goes upwards. So the thing that remains there is that there was only 50% chance that it was supposed to go down and 50% chance that it was supposed to go up. So the other 50% is actually got from the amount of risk you are willing to lose in that trade, or whatever amount you're risking in that trade. That's where the other 50% comes from. So you have a very good strategy, a very good one. It's 50% successful. And then the remaining 50% you actually get from the risk management. So if your risk management is really good, that gives you a good money. So the first thing, I cannot say that a strategy is actually above 50. What is always above, what is always 50% above, or 50% is actually the risk. If you know how to understand, if you know how to control the risks very well, you're already 50% successful. That's the most important thing. So the first thing I want to mention is that when preparing for a trade, you have to know everything on this screen. Try to understand what everything in this screen, whatever it means. Don't just trade because this is an MT4, you have a platform, you focus mostly on these ones. This is a level you're supposed to buy, this is a level you're supposed to sell. Don't just do that. You have to understand everything in this chart. Understand what these lines means. Understand what every candlestick means. Understand what all this, because they are useful to you. So the first thing, if you are trading properly, you want to understand day trading. Understand that whatever you're seeing here, these lines, these are called period separators. And if you are looking at 1 minute, then anything that is within 2 period separators stands for a day. If you're looking at 15 minutes, same thing. Anything that like this, all these candles that you're seeing in between these two lines actually stands for what has been happening in a day. And if you look for 15 minutes, the same thing. Say a day, a day, a day, another day, another day. Is today where we are today. So 30 minutes, the same thing. Day, at previously, and then this also the today. So what you need to know is that you have to get the previous day's lowest low, then also get the previous day's highest high. So yesterday basically we traded within this range, and the previous day this was the highest high, yeah, then this is the lowest low, yeah. Opened here, went down, then came back up to this level, traced down, but ended up closing here. If somebody asks you that what is the range for yesterday, this is what happened. This is the highest high, this is the lowest low, highest high. This is the highest high for yesterday, and then this is the lowest low. So if you're that person who's trading a breakout, you may just want to say that if price goes below the previous day's lowest low, we look for a sell. Price goes above the previous day's highest high, look for a buy. On the 1 hour, the same thing, stands for a day. And then on the 4 hours, now there's a difference. Everything you're seeing in between these two lines actually stands for what has been happening in the whole week. So the previous week, we actually had a high of this, yeah, then a low of this one. Which means if somebody asks you the range for the previous week, you can basically see it. You don't have to go to the weekly to find the highest high and the lowest low. You can see them straight from the 4 hours. And this week, we've somehow gone above. This is the highest high we've seen so far. And then this is the lowest low we've also seen so far. Which means that if price goes above that highest high, that should be a very good low buy, a short-term buy. And if it price breaks below the previous week's lowest low, which is this one, we're basically continuing to the lower side. So the strategy which I like for this one is that you need to learn how to trade breakouts very well. Trading breakout does not mean that you start looking for, anytime price goes above a level, you look for a trade, and if price goes below a level, you look for a sell. No. You need to understand the trend very well. Look for those pairs that you understand their trend. If pair is heading to the lower side, you've seen a pin bar, maybe an engulfing candle, or there's a gap towards the bearish side, that means you're selling. So you look for breakouts in that direction, which means if this was a sell, you can see we were here, swing high, continued down, retraced slightly, then it continued down, came back, and you monitor how price is retracing. Is that, and then it continued down, it retraced, then it continued down, it retraced, and then somehow we are consolidating. So what this means is we are heading somehow to the lower side. If price keeps making lower highs, that it goes down, but when it retraces, it does not outdo the previous highest high. That means you're still down. So continue down, traces, but still no highest high. No, we haven't outdone the previous high. Continue down, came back, same thing. Continue down, came back, down, then back, down, and for the first time, we've actually gone above the previous highest high, which was this one. So what this break means is that the price may likely continue to the upper side. So if you are somebody who is you want to trade daily, you've already known that the price may likely continue to the upside. But what's happening now is that the price is going to the lower side. So the best to do, wait for it to mature first of all on the 4 hours. Wait for what you want to happen first on 4 hours, which means wait for price to break above 4 hours. Then while that is happening, that the price has gone above that level in the 4 hours, you now move to a lesser time frame, which is daily. So that means we'll not do anything until the day that price actually gets above this level. Then when that happens, we scale down to a lesser time frame, then we look for a trade from that point. So the most important thing normally is not what you're going to trade, but understand where the price will go ultimately. So that if you pick a trade, you pick it in that direction. Does that make sense? I hope that should make some sense. That if you want to enter trade correctly, whatever you are trading, if you want to day trade correctly, understand what is happening on the higher time frame. So if you are going to do 1 hour chart, understand what's happening on the daily and the 4 hours. And if you're going to do 15 minutes chart, understand perfectly well what's happening in the 4 hours and 1 hour chart. And if you're doing 1 minute chart, understand properly what is happening on 30 minutes and 15 minutes and also 1 hour. So I don't recommend someone trading like a 15 minutes or 1 minute chart. You can do 15. I don't recommend 1 minute. There are a lot of fluctuations on 1 minute chart that if you have a strategy, you may not be able to see exactly what you're doing. But it's really good if you're using a program to trade, then you can use 1 minute still, okay? So another thing, you have to learn how to draw your levels correctly. And a good level is not just a level where price was bouncing off from. You have to look at how price is actually breaking that level. If you have a level that you say it's strong, but price actually breaks above it anyhow, that's not a strong level. A good level must hold. Like if you find this, look at the line I'm having on my screen, which is this. Very good resistance. Just check, this was from 23rd of August. Price has not been able to rise above this level other than this day here, which I cannot say this was a breakout. Instead, I want to cover it up as a zone. This one. Look at how good this level is. A resistance, continued down, it came back up, resistance, it continued down, came back as a resistance, continued down, and then it came back as a resistance. So normally the correct way to enter day trades is actually not when price is approaching this level, but when price has already reversed from this level, which means that when price is continuing above and is attempting to break above with this tail on this, with this one, don't enter when price is going this direction, but wait for price to continue up, then come back and close here. Then the next one you can now pick a sell. So after this breakout, after this attempt to break above, you can enter the subsequent ones. This was a trade, and then this was also a trade here, and then we also have this one as a trade. So the question is, how comes I've not said this as a sell? When price has gone down completely after reversing from a level, this is a resistance. When it's approaching that level again, when it's approaching, especially if there's good momentum, don't want to enter when this is happening. Instead, wait for price to go completely up, then it should come back down, and when it closes below or within that zone, that's the next time it comes back again, you look for a sell. So you not enter when this is happening. When it's approaching for the first time, you don't enter. But if that approaching pushes the price up and then it comes back and closes below, after that you look for a sell. I hope that makes sense. That you're not entering when price is approaching that level. You're actually entering when price has already attempted to go above and have come back and close below. That's the moment you look for a sell. It continues the same way and back as a resistance, which means this was a sell. Yeah, enter. After that, so have this as a sell. Continue down, it broke massively above, it came back down, broke above, and there's a break below, which means if you are doing 1 hour, price needs to come back to this level before it continues to the lower side. So that means that you will be focusing so much on a sell, despite the fact that on the 4 hours you're actually looking for a buy. So if you sell it there, you take your profits early. Don't let your trades run for a long time. If you've entered a sell around a level like this, and you know very well that a higher time frame is actually showing you something opposite, you don't remain on those trades for a long time. You enter and exit immediately. Like after 6 hours you get out, 4 hours you get out, 8 hours you are out. Does that make sense? I hope that should make sense. This is another very good example on USDJPY. Learn how to draw your levels correctly. That is the most important thing. Is DJPY. Need to look at this chart properly. So the first thing, I'm going to trade 1 hour. So I have to understand what's happening on the daily. The daily 4 hours. Which means go to daily first of all, and you draw your levels first. Have this resistance. Then you also have this support. So after you have that, now known that on the daily chart, you're actually looking at this, also looking at this level here, which means anytime the price approaches any of these levels on a lesser time frame, if you're looking at now 1 hour, don't delete those lines. You know very well this is the place to look for a sell, the place to look for a buy. That's the first step. We've already marked our levels on a higher time frame. Now we are scaling down to a lesser time frame to get precision. Have that. Second, good separators. We have that. So we have these levels. This is the resistance, and then this is the support. And just look at how perfect this level is, the one on top. A very, very good resistance. This was since 2nd of August. It has been used as a resistance. Continue down, it came back, the resistance, as a resistance, as a resistance. It should come back as a resistance. So if it comes back again, you know very well this is a sell, because even on the daily, we are also having the same thing. The mistake most of us make is that somebody will come straight to 1 hour, draw his levels, and then begin looking for trades. It should not work like that. Get your levels from the highest time frame possible. Then try finding the same levels on a lesser time frame. So if you've known very well that this is a daily level, you now trade confidently. When price comes back to this place and then it gives you a pin bar, you're free to sell it. If price comes down to this level and gives you a bullish pin bar, you're free to buy it. On the other side, if price breaks above this level, this is now the interest part. If price breaks above this level, it has to close like that on the daily for you to start buying it. So this is different from a reversal from it. Reversal, when price is reversing from this level, you don't wait for it to reverse on the daily. You can just sell when price is here on a lesser time frame. But if price breaks above this level, you find that a 1 hour chart, the candle has actually closed above 106.75. You have to wait for the same close on the daily, because that close above this level on the 1 hour could actually be a tail on the daily. So you have to wait for a real candle of the 1 hour, like something like this. From having this, these are just candles. This is the highest close resistance. If price comes back to this level, 1 hour may have closed above. You have to wait for the daily candle to actually also close above this level. And if that has happened, you can now scale back to the daily, and then you wait for that retracement. Wait for price to come back down up to this level here, and look for a buy from that point. So this is something which most people make the mistake. You find that somebody's day trading, and the first thing they do, they ignore the higher time frame, and then they only trade the lesser time frame. Somebody will come to this set immediately and draw their levels and start trading. It should not be like that. You have to, if price is to break this level, wait for that break to happen on the daily. Then after that, the next day you're free to start buying. Same thing. The price is to proceed downwards. When price is coming back to this level here, the one at the bottom, you can look for a buy in case it does not break above. You can start looking for a buy immediately. You don't have to wait for the daily to show you, but you can just look for a buy. But if it breaks below like this, then you have to wait for daily also to close below that level, which means you want to see an actual candle close up below 105.00 on the daily chart. Then the next day you can now wait for a sell from this level. Does that make sense? That should make some sense. At least it should be clear that we are not just selling because price is below a level. If the 1 hour chart breaks below this level, but the daily has not done the same thing, that could possibly be a false break. So these are the cases where you enter a trade here, then it sells off just slightly and then comes back and close above. Then if you check daily, notice that was just a tail. So we don't want to sell tails, we want to sell real candles. And if you pick a trade correctly, pick both the tails and the body. That makes sense? We have another good example here. Sorry. We have this Australian dollar, US dollar. Just look at this. Look at this pair here. If I'm asked to draw a level, this is a very good resistance. We have this as a support first. There. Then we also have this as a resistance. Yeah. So have this as a support. So have that as a support. So if you check this chart properly, you can actually see that we had this as a resistance, and then there's a perfect break above, retracement, it continued up, retracement before it continued even higher. So if you are checking this chart properly, you notice that the daily was actually a sell. The price supposed to continue to the last side, but then it broke above, retraced down, continued up, retraced down, and then it spiked even higher. This, according to the 30 minutes, was a buy. But if daily was a sell, while this was showing you a buy, it's better to ignore that trade. So you only look for places which is supported by the higher time frame. If you see a sell on the daily and then the price seems to be moving upwards on a lesser time frame, wait for those people selling on the lesser time frame to finish selling first, buying first of all. Then you sell it with those guys who are selling on the daily or on the higher time frame, whichever higher time frame you choose to trade with. If a lesser time frame is showing something opposite, wait for those people who are doing something opposite on the lesser time frame to finish what they are doing first of all. Look for a sell after that. So this is one thing. Yesterday, I actually thought this was a sell. I took a sell. Just look at this. There's this bearish move. We have an active trend to the lower side. We had a support which was broken. Then price came back to that level and closed below. It tried up but then closed below. Then this candle here actually signals that the price is proceeding to the lower side. So when price was coming back to the upper side, when it was pulling back upwards, I actually thought this was a retracement. So I took a sell. When it came back to this resistance here, this resistance, I took that sell and then I was stopped immediately. So after being stopped on this one, now know very well that this move, although there's a sell on the daily, but you're likely continue to the upper side because the price has gone above a good place where you're supposed to have been selling from. So I don't recommend you pick this buy though, but if this could have happened yesterday, that the price continues up and comes back and breaks below the same place which I sold from but I was stopped, I would simply wait for retracement back, take a sell. this is one thing I would do. First of all, before I do anything, I would wait for price to retrace back, then you pick a sell from this point. So I sold it the first time, it came to this level. Yesterday, I sold it there, and then we also had a buy here. So I took that sell. I knew this was a buy, but I didn't take it because the daily trend was downwards. So if this could have happened, that instead of price proceeding upwards, actually came back down, I would wait for a sell here. This could be the correct place to look for a sell from, with my first take profit around this zone here, down at the bottom. So I hope that makes some little sense. So if you don't understand exactly what's happening, if you don't understand what is happening on a chart, you can add your indicator. And this so by far my best indicator. Have this. I have multiple ones. Second. This is a very good indicator. I really this. But then before I proceed, this I want to say this just these are just moving averages that have been placed together. They're just moving out. There's nothing special to this indicator. This is just a moving average. I've placed two. We have this. This is as the simple one, first moving average. Then we also have the next one. Then we have this one. This is now the histogram. Just a normal indicator. There's nothing special so much to it, but it helps me understand the trend. So if I'm seeing this, that the price is proceeding to the upper side, that means we're supposed to be looking for buy position. So if you check daily, look at this. There's an active downtrend. Then we can see price proceeding to the upper side. What this simply means is that the move we are seeing upwards would be a very good retracement. So if it does not break above this indicator, look for a sell. So this is just one thing which you need to understand, that if price is proceeding downwards on a higher time frame or in a particular direction on a higher time frame, but on a lesser time frame we're actually seeing price go the opposite direction. That opposite direction could just be a retracement. So you wait for it to finish. Let those people who are trading lesser time frame, maybe 1 hour, to continue doing what they're doing. Then when they are finished, that's when you look for a sell. So the main reason I'm focusing so much on a sell is because on the daily, we're actually looking for a sell, which means if this is a sell and I'm day trading, on the 1 hour, I'm actually looking for places to sell from. So I'll basically just have that line, then also have one on top. Then the next thing is to wait for price to come back up to those levels. If price can come back perfectly up to either this level, which it has done already, and gives me a signal, I'll sell it. If it breaks above, I'll still sell it there. And if it goes even higher, then I'll focus on other levels, which is now this one. This is now the other one. So have this. So if you are looking at this chart, I now know very well that although there's a move to the lower side, price is likely coming back up to either this level, this one, or should continue upward. So if that happens, that there's still a sell based on this indicator on a higher time frame, but the price continues to move upwards, that's only giving you a good place to look for a sell from. So thank you very much. As I mentioned at the beginning, I want to repeat here again that the most important strategy is not the one which I've mentioned. It is the amount of risk you're willing to trade. So if you'll be looking for a sell, like I've mentioned, if you'll be looking for a sell from this point, or this point, the amount of risk you're willing to put in that trade is as significant as the strategy itself. So don't risk a lot. Although you're seeing a sell, looks good that this could be a very, very good sell, don't sell it unless the risk that you're going to put in that trade is actually reasonable. So don't just trade because your strategy said this is a sell. No, the amount of risk you put in any given trade is as significant as the strategy itself. So if you're looking for a sell, around any of these levels, if you look for a sell here, sell there, sell there, if you find that the volume you're willing to put in that trade will actually risk your account, reduce the volume, reduce it. There's no reason for having big volumes if you're actually losing a lot of money. Reduce the volume, and what I mean by volume is the lot size. If you have 0.1, if trading 0.1 actually risks most of the money you have in your account, reduce it. There's no harm in that. But if entering 0.1 actually will reduce the risk such that you will not get anything, you can still increase it. That is why the amount of capital you're having in your account is also very significant. It enables you to open big volume and also to be able to risk reasonable amount for reasonable profits. There's no point for doing 0.01 if you have like 1000 USD in your account. Even if your strategy says so, there's no reason for that. You should understand that if you have at least 1000 USD, you could do a very good volume and also be able to make good money. So get a good strategy, and that strategy will sum up for maybe like 25%. Then you add 50% for risk management to that 25. That gives you 75% success rate. I hope that makes sense. I'm not confusing anyone. That if you have a very good strategy, that strategy is maybe just 25% accurate. If you enter trade, you only have 25% chance that it will go your way. So the remaining 50% is actually got from risk management. How much you are willing to risk in that trade. Get a very good strategy, but understand that with that strategy, you are still just less than 50% successful with it. Then the remaining 50% get from risk. So the other, actually, it should be that if you enter trade, that trade is only like the risk aspect of it is what sums up to 50%, which means whether you have a good strategy or you don't have a strategy at all, you're already 50% successful if you have a proper risk management. The remaining 50%, you get it from the strategy, the one you're using. So thank you very much. That should bring us to the end of this webinar. We meet again on Wednesday next week.